Hello everyone. So today we will solve question 13 based on including the point of unrealized profit. But only workings I will explain it to you in detail, and then consolidated balance sheet and its notes you will try on your own, and then you play the video and verify whether you got it correct or not. Okay, now almost in all the further questions workings will be very important. So when repeated question and concept comes, like yesterday we did the concept of unrealized profit, it's a repeated concept. So in the repeated concepts I'll do only workings in detail, and then balance sheet and its notes you all try on your own. Answer you'll find in the video lecture, but you just verify whether you got it correct or not. So be attentive, understand the complete question first. Following are the assets and liabilities of P Limited and Q Limited as on 31st March 2019. Equity share capital of rupees 10 each. P Limited 6,50,000, so 6,50,000 divided by 10, 65,000 shares are there. And Q Limited 2 lakhs, so 2 lakhs divided by 10, 20,000 shares are there. And of course Q Limited must be a subsidiary company, also they have lesser share capital. So put cross on share capital of Q Limited. Even general reserve 50,000 and 25,000, put cross on 25,000 of Q Limited. Only P Limited's amount will come in consolidated balance sheet. Profit and loss account also put cross on 30,000 of Q Limited. Only 60,000 will come in consolidated balance sheet. 12% debentures. Okay, this equity share capital will come in share capital. General reserve and P&L account will come in reserves and surplus. 12% debentures will come in long-term borrowings. It will get consolidated. Only 40,000 of Q Limited is there. Bills payable and creditors will come in trade payables. Goodwill is already there in the balance sheet. So this goodwill will come in intangible fixed asset. Now listen carefully everyone. I repeat, listen carefully. If in our working note 5 control chart B, we get goodwill, then we will add that goodwill in this goodwill in intangible fixed assets. If we get capital reserve in our control chart B working note 5, then we will adjust with the goodwill. How will we adjust with the goodwill? If capital reserve is more than 45,000, then you minus goodwill from capital reserve and reserves and surplus. And if capital reserve is less than 45,000, in our working note 5, we get capital reserve less than 45,000, then that amount you minus from goodwill in intangible fixed assets. So I repeat it once again, listen carefully. 3 different situations are possible. Number 1, if we get goodwill, okay, in our working note 5 control chart B, if we get goodwill, then simply add it in this goodwill in intangible fixed assets. Second, if we get capital reserve more than 45,000, then since capital reserve is more, you minus goodwill of this 45,000 from capital reserve in reserves and surplus. Third, if we get capital reserve but less than 45,000, then goodwill amount is more. So you minus capital reserve from goodwill in intangible fixed assets. It means smaller amount you minus from bigger amount. So if you get capital reserve more than 45,000, then smaller amount 45,000 you minus from capital reserve in reserves and surplus. And if you get capital reserve less than 45,000, then goodwill 45,000 is bigger amount. So capital reserve you minus from goodwill in intangible fixed assets. So 3 things are possible. We will see what situation we get when we make working note 5. Next, plant and machinery and building will come in tangible fixed assets and will add all the 4 amounts. Investments 1,50,000 and 30,000 will come in non-current investments. Important point to be noted here is don't cross investments. I repeat, don't cross investments, because is it mentioned here investments in shares of subsidiary company Q Limited? Is it mentioned? No, it is not mentioned. So we cannot assume that all the investments of 1,50,000 are in the shares of subsidiary company only. Okay. This investments can include some outside investments also. So, and also subsidiary companies 30,000 of investments are also there. So these investments which are outside investments other than the shares will continue to appear in non-current investments. Okay. So don't put cross on investment right now because it is not mentioned in the shares of subsidiary company. Stock will come in inventories. Debtors and bills receivable will come in trade receivables. Cash and bank will come in cash and cash equivalents. Also, we have contingent liability for bills discounted. So if any intercompany adjustment is there, you will simply minus it from contingent liability. Now look at additional information. P Limited acquired 12,000 shares in Q Limited. So this will help us in getting degree of control. How many shares are there in Q Limited? 20,000. From that 12,000 are acquired by P Limited, means remaining 8,000 are of minority shareholders. At rupees 12 per share, so what are the investments made by P Limited in the shares of Q Limited? 12,000 shares they have acquired at the rate of rupees 12, means they have invested 1,44,000 in the shares of Q Limited. This amount will come in control chart B. Okay, where we start in control chart B, we start with investments of holding company in the shares of subsidiary company. There you'll take 1,44,000. Now this is what I was explaining you here. What are investments of holding company? 1,50,000. Out of this, only 1,44,000 are in the shares of Q Limited. This amount will only get cancelled and not appear in the consolidated balance sheet. But 1,50,000 minus 1,44,000, 6,000 are some other outside investments. Okay, 6,000 are some other outside investments. They will continue to appear in consolidated balance sheet. Okay, so entire 1,50,000 does not get cancelled. Out of 1,50,000, how much amount holding company has invested in the shares of subsidiary company? 12,000 into 12, 1,44,000. Only that amount invested in the shares of subsidiary company gets cancelled. Remaining amount of this 6,000 plus 30,000 will continue to appear in consolidated balance sheet. Keep this in mind. Further, on 1/10/18, that is the date of acquisition, that will help us in getting time ratio. On which date, circle this, Q Limited had general reserve of rupees 8,000 and P&L account of rupees 10,000. So what is 8,000 and 10,000? It is not the opening balance. It is the balance on which date? 1/10/18, on the date of acquisition of shares. We'll see in the working of P&L and general reserve how to deal with this. But keep it in mind, 8,000 and 10,000 is not the opening balance. 8,000 and 10,000 is the balance of general reserve and P&L account on 1/10/18. That is the date of acquisition. Look at the entire adjustment once again. P Limited acquired 12,000 shares in Q Limited at rupees 12 per share on 1/10/18, on which date Q Limited had general reserve of 8,000 and P&L account credit of 10,000. Bills receivable of P Limited include 15,000 accepted by Q Limited, that is intercompany adjustment. Put tick on bills payable and on tick on bills receivable. We will minus 15,000 from bills receivable as well as bills payable. Contingent liability of rupees 4,000 for bills discounted as shown in the balance sheet of P Limited relates to accepted by Q Limited. This 4,000. So that is again intercompany adjustment. But here, as I made you write in the notes, when there is intercompany adjustment in contingent liability, it will have only one effect. Simply minus from contingent liability. Creditors of Q Limited include 10,000 for goods supplied by P Limited. So this 10,000 is again intercompany adjustment. We will minus from debtors as well as creditors. Put tick on debtors and creditors, on which P Limited made a profit of rupees 2,000. So from this we'll find unrealized profit, URP. Now this is important. Goods are supplied by P Limited, means P Limited has sold goods to Q. P means holding has sold goods to subsidiary, parent has sold goods to child. So it's a downstream sale. I explained you in the last lecture, if it is downstream sale, then entire amount will be treated as unrealized profit. If it is upstream sale, then only holding company's share will be treated as unrealized profit. Here, goods supplied by P Limited term is very important. Okay, this term, goods supplied by P Limited, indicates holding company P, parent company P, has sold the goods to the child subsidiary Q Limited. So it's a downstream sale, means full amount will be treated as unrealized profit. What full amount? 2000. Now, 40% of goods were still in stock on 31st March 2019, means 60% of goods are sold to outside customers. That becomes realized profit. We discussed that unrealized profit is always on the goods which remain unsold. So 40% goods remain unsold, means only 40% of 2000 will be unrealized profit, that is 800. Okay. Out of 2000, since 40% goods are only still in the stock, 2000's 40%, 800 will be unrealized profit. What will we do with unrealized profit? Minus from P&L account and minus from stock. Okay, unrealized profit of 800, minus from P&L account and minus from stock. So let us make the 5 set of workings. All of you write down 5 set of workings along with me, and if you want, you can try the workings on your own also, but this profit and loss account and general reserve is a new point, so don't try on your own, do it along with me only. Okay, since opening balance is not given, balance on 11018 is given, so it's better that you do up till general reserve first 3 workings along with me, then 4th and 5th and 6th you can try on your own. First working, degree of control. All of you write down first working, degree of control. 2 columns will be there, H Limited and minority interest. Now total how many shares are there in subsidiary company? 20,000. So all of you write down 20,000 equity shares of S Limited. Now out of this 20,000 shares of S Limited, how many are acquired by holding companies? Look at adjustment 1. P Limited acquired 12,000 shares. Okay, it's not H Limited here, the name is P Limited. So out of this 20,000, 12,000 shares are acquired by P Limited as per adjustment 1. Remaining 8,000 are with minority shareholders. Now if you cancel the zeros, then 12 divided by 4 is 3, 8 divided by 4 is 2. Both are divisible by 4. So 3 is to 2, 3 plus 2, 5. 3 by 5 and 2 by 5 is the ratio of degree of control. Second working, we will make time ratio. 3 dates we have to write. Beginning of the year is 1/4/18. Okay, because balance sheet is on 31st March 19, means beginning of the year 1/4/18. See in adjustment 1, what is the date of acquisition? 1/10/18. The shares are acquired on 1/10/18. And what is the date of year ending? 31/3/19. So April to September. Okay, 1st October means April, May, June, July, August, September. So pre-period is 6 months. And then October to March, post acquisition period is also 6 months. So 1 is to 1. Both are divisible by 6. 1 is to 1. 1 by 2, 1 by 2 is the time ratio. Then third working, now this one is important. How will it change here? Understand it. Profit and loss account. The 3 columns what we make is total, pre and post. Okay. Here we don't have opening balance. Here we have balance on 1/10/18. See the first adjustment once again. P Limited acquired 12,000 shares in Q Limited at ₹12 per share on 1/10/18. On which date Q Limited had general reserve of 8,000 and P&L account of 10,000. So this 10,000 is not the opening balance. It is the balance on which date? 1/10/18. So all of you write that way only, not opening balance, but you write balance on 1/10/18. That is the date of acquisition. How much P&L account balance is there on 1/10/18? 10,000. Now 1/10/18 means date of acquisition, so entire amount you'll take it in pre-column. Now you'll not get profit during the year. Whatever amount remains would be profits after 1/10/18. Okay, this difference will come in the working. What is the P&L account balance in balance sheet? 30,000. Out of that 30,000, balance on 1/10/18 is 10,000. Means what profits did the company earn after 1/10/18? Remaining of 20,000. Now, after 1/10/18 means this entire 20,000 is post acquisition profit only. So don't distribute this 20,000 in the time ratio. Don't do that, because 10,000 is the balance on 1/10/18. So 30,000 minus 10,000 is the profit. After 1/10/18 means it is post acquisition profit only. So further we don't have to distribute that in time ratio. That is the difference. Yes, had it been opening balance, then we will do the same working as we do it traditionally. Profit during the year and then distribute in pre and post. But this is not the opening balance. 10,000 is the balance on 1/10/18. So remaining amount is already after 1/10/18 means entire 20,000 you'll take in post acquisition period. Total pre-acquisition profit 10,000 and post-acquisition profit 20,000. Exactly same way we will make for general reserve also. So same working further for general reserve. Here also opening balance is not given. So what is the balance on 1/10/18? 8,000. So all of you write down balance on 1/10/18 8,000. This balance on 1/10/18 will be entirely taken in pre-acquisition period, and then remaining would be the reserves after 1/10/18. Okay, remaining amount would be the reserves after 1/10/18. What is closing balance of general reserve? 25,000. From 25,000, if you subtract balance on 1/10/18 8,000, then what are the reserves after 1/10/18? 25,000 minus 8,000, 17,000. And after 1/10/18 means entire 17,000 you'll take it in post-acquisition column. So pre-acquisition reserves are 8,000 and post-acquisition reserves are 17,000. So this difference we have in working note 3. Okay, what difference? We don't have opening balance given in the adjustment, but we have the balance given on the date of acquisition. Because of that, remaining amount is not profit during the year or transfer to reserves during the year. Remaining amount is directly the amount after acquisition. Now you all can try working note 4 and 5 on your own. You can pause the video and make working note 4, 5, and even unrealized profit workings you can try on your own. And then you can play the video and verify whether you got it correct or not. However, I am explaining in detail, but if you want, pause the video and try working note 4, 5, and 6 on your own. So working note 4, control chart A. Three columns will come here: total, holding company P Limited, and minority interest. And in this workings, all amounts will be distributed in the ratio of degree of control 3:2. So 3/5 and 2/5. All amounts will be distributed in this ratio. First A, we will take capital profits. In that, pre-acquisition profits. Now what are pre-acquisition profits? All of you see here, we got in P&L account workings 10,000. Okay, we get it from working note 3. What are pre-acquisition reserves? That also we get from working note 3. See in reserves, what is pre-acquisition amount we obtained? 8,000. So 10,000 plus 8,000. What are total capital profits? 18,000. Now 18,000 into 3 by 5. Or if you do it, 18,000 into 3 divided by 5. You'll get 10,800. And 18,000 into 2 divided by 5 would be 7,200. Then B, revenue profits. Okay, B would be revenue profits. That will include post acquisition profits that we get from working note 3 again. See what are post acquisition profits? 20,000. Then post acquisition reserves. That also we get from working note 3. What are post acquisition reserves? We got 17,000. Now 20,000 plus 17,000, 37,000 are revenue profits. Now 37,000 into 3 divided by 5, 22,200, and 37,000 into 2 divided by 5, that is 14,800 is minorities share. And then we will take the third item in this working, share capital of Q Limited. Okay, subsidiary company Q Limited. What is share capital of Q Limited? All of you can see here in the balance sheet. ₹2 lakh. Okay, what is share capital of Q Limited? Okay, not S Limited, Q Limited in first working also write Q Limited. ₹2 lakh. That 2 lakhs again we will distribute in the ratio of 3:2. So 2 lakhs into 3 by 5, that is 1,20,000, and 2 lakhs into 2 by 5, that is 80,000. Now total of this column will directly give us minority interest. So all of you do it, 7,200 plus 14,800 plus 80,000, that comes to 1,02,000. Okay, 1,02,000 is the amount of minority interest. If you have tried the workings on your own and got this correct, then you are progressing well in this chapter. Now, even working note 5, you should have tried on your own and verify what answer do you get. Control chart B, that is cost of control. Okay, control chart B, that is cost of control. Now, here we will start with investments of P Limited, that is holding company, in the shares of Q Limited, that is subsidiary company. Okay, what are investments of P Limited in the shares of Q Limited as per adjustment 1? 1,44,000, 12,000 into 12. Okay, P Limited has acquired 12,000 shares in Q Limited at ₹12 per share. So 12,000 into 12. What are the investments of P Limited in the shares of Q Limited? 1,44,000. Now what did we discuss? From control chart A, first amount and third amount of holding company we will minus in the next working, and middle amount we will add in P&L account in balance sheet, consolidated balance sheet. Okay, so this first and third amount we have to minus here in control chart B, 10,800 and 1,20,000. So you will minus face value of shares held by P Limited. What are the face value of shares held by P Limited? This 1,20,000 we have to minus it here. And then share of P Limited in capital profits of Q Limited. Okay, share of P Limited in capital profits of Q Limited. That is this first amount we have to minus here, 10,800. So 10,800 further we will minus. Okay, first and third amount of control chart A of H Limited column will get subtracted in the next working. So 1,30,800 we will minus. We'll get goodwill 1,44,000 minus 1,30,800. That comes to 13,200. That is the amount of goodwill. Positive means goodwill. Now, as I discussed with you, three situations are possible here in balance sheet. I discussed with you. We get the first situation. We get goodwill, so you'll simply add it in the goodwill. Already in the balance sheet, there is a goodwill of 45,000. In that, further we will add this goodwill of 13,200. So it will become 45,000 plus 13,200, 57,200. Now, sixth working, unrealized profit, all of you. Again, you must have tried this on your own and verify whether you got it correct or not. Three informations we require to find unrealized profit. First information what we require is goods are sold by whom to whom. So goods sold by, here they are sold by holding company P Limited to subsidiary company Q Limited. Now, we discussed this in adjustment number 4, that goods are supplied by P Limited. So goods sold by P Limited to Q Limited, which means it is downstream sale. Okay, so in bracket we'll mention that it is downstream sale. Okay, from parent to child, it is a downstream sale. Now, what are the goods sold by holding company to subsidiary company P Limited to Q Limited? It's given creditors of Q Limited include 10,000 of goods supplied by P Limited. So goods sold by P Limited to Q Limited 10,000. Then goods remaining unsold. Second information we always write percentage of goods remaining unsold. They are given as 40%. See the adjustment for what proportion of goods are remaining unsold. 40% of goods are remaining unsold. And third information what we require is the information of profit. What information of profit is given to you? 40% remain unsold and clearly given P Limited made a profit of 2,000. Total profit made is 2,000. So unrealized profit is only on unsold goods. Means 2,000's 40%. Unrealized profit will be 800. Okay, 2,000's 40%. Unrealized profit will be 800. Now, since it is downstream sale, entire 800 we will minus from P&L account in consolidated balance sheet, and we will minus from stock in current assets. Okay, that's why we have already put tick over here, minus from P&L account and minus from stock. Now see this, from P&L account we have to minus this 800 unrealized profit, and we have to add this 22,200, the middle amount of H Limited in control chart A. Then in bills payable as per adjustment 2 you have to minus 15,000. In creditors as per adjustment 4 we have to minus 10,000. In stock as per unrealized profit we have to minus 800. Okay, last working note 6. Then in bills, in debtors as per adjustment 4 we have to minus 10,000. And in bills receivable as per adjustment 2 we have to minus 15,000. And in contingent liability as per adjustment 3 we have to minus 4,000. So all of you make the balance sheet and its notes entirely on your own, and then you play the video and verify whether you got the balance sheet correct or not. So pause the video and try entire balance sheet on your own. Yes, I hope all of you would have done with the balance sheet. Now check your answers, everyone. In equity and liabilities, shareholders funds, share capital is 6,50,000. See in the notes. Authorized capital is question mark and double underline in that. And issued, subscribed and paid up capital, only holding companies shares will come. 65,000 shares of 10 each, 6,50,000. Then all of you check reserves and surplus from note 2 must be 1,31,400. Now in reserves and surplus, first general reserve of P Limited 50,000 will come as it is. Okay, so general reserve of P Limited 50,000 as it is. Then profit and loss account also only of P Limited, that is 60,000. In that we will add this control chart day amount of 22,200 and we will minus this 800 of unrealized profit. So 60,000 plus 22,200 minus 800, you all must get 81,400. Okay. There is no amount, this 9,75,000, nothing is there. Yeah, 50,000 plus 81,400, 1,31,400. So 6,50,000 plus 131,400, 7,81,400. Minority interest we directly get from working note 4, that is 1,02,000. Okay, directly from working note 4 you'll get 1,02,000, and here you can mention in bracket working note 4. Then long-term borrowings from note 4 we get 40,000, that is 10% debentures only of Q Limited. Then trade payables from note 5 we get 1,05,000. Now look at note 5. In that creditors of P Limited are 55,000, Q Limited are 25,000, and you will minus intercompany adjustment 10,000, so 70,000. Same way bills payable of P Limited are 30,000, Q Limited are 20,000, and you will minus intercompany adjustment 15,000, so 35,000, and 70 and 35, 1,05,000. Total amount of balance sheet 7,81,400 plus 1,02,000 plus 40,000 plus 1,05,000, 10,28,400. Now in non-current assets, fixed assets, tangible, you will have 5,95,000. Look at the notes. In that you will have plant and machinery of P Limited 2,30,000, Q Limited 1,20,000, total 3,50,000, and building of P Limited 1,85,000, Q Limited 65,000, 2,45,000, total 5,95,000. Intangible, I told you here, goodwill is already there in the balance sheet, 45,000. In that further you will add this goodwill amount of 13,200. So 45,000 of goodwill in the balance sheet plus 13,200 of goodwill on acquisition, you get 58,200. And then non-current investments is also important. Here I told you that entire investments don't get cancelled. Only 1,44,000 in Q Limited gets cancelled. So what will come in balance sheet? This 6,000 of outside investments plus this 30,000 of Q Limited investments, 36,000. Okay. 6,000 of P Limited's outside investments. Don't write in bracket, just for understanding I'm telling you. Outside investments, and Q Limited 30,000, so total 36,000. Total of non-current assets 595,000 plus 58,200 plus 36,000, 689,200. In current assets, inventories 1,29,200 from note 9. You all can see in inventories P Limited 90, Q Limited 40, minus unrealized profit 800, so 1,29,200. Then in balance sheet you will have trade receivables of 1,35,000. So in trade receivables, debtors of P Limited 70,000, Q 30,000, minus intercompany adjustment 10,000, so 90,000. Bills receivable of P Limited 40,000, Q Limited 20,000, minus intercompany adjustment 15,000, so 45,000. Total 1,35,000. Then cash and cash equivalents 75,000. So cash and cash equivalents you all will have P Limited 40,000, Q Limited 35,000, 75,000. And we will also have contingent liability below the balance sheet. So that will also come after the total of balance sheet. Okay. So after the total of balance sheet, you'll have one more item. You'll write contingent liability. That will come as per note number 12. See in note number 12, what is contingent liability? Bills discounted 4,000 plus Q limited 6,000 minus intercompany 4,000. So simply 6,000. So below the balance sheet in the outer column directly you'll write contingent liability of 6,000. Okay. So I hope all of you would have got the balance sheet correct. This is how we have to solve the questions. 5 workings are compulsory, and then if unrealized profit is there, 6 workings will be there. So that'll be all for today. Bye everyone. Take care. See you in the next lecture.